Hey guys, Max here, and this is your daily video update for yesterday, the 23rd of January. It was a Sunday. Markets were closed, but there's still plenty to talk about. We're going to cover a few issues from some smaller countries, things that we don't normally get some time to look into, so let's just get right into it. Now, of course, crypto markets were open, and they were pretty volatile, as is all too common these days. Unlike Saturday though, most coins saw falls in their prices, and by far more than the gains yesterday were. Bitcoin was down 4% and is sitting around $34,000 again. Ethereum was down 8% and is sitting around $2,300 again. For all altcoins, we saw declines across the board. Binance was down 9%, Cardano was down 12%, Solana was down 18%. Name a slightly obscure coin with a market cap somewhere in the region of $5 to $50 billion, and it probably fell by about 10% yesterday. Now, why did this all happen? Why did it reverse the trend from the day before? Well, it seems to just be more of the same. Poor sentiment from investors, people selling out of positions, preparing for tougher monetary environments, liquidations from those who like to trade on margin, and just fear all around that a bear market is going to take hold and that crypto winter might even be here. Now, I don't know if I would say that we're there yet. We're definitely in a bear market for crypto, and we're probably on the way to crypto winter, but I don't think it's actually here yet. One interesting way to measure whether or not we are in a crypto winter will probably be the attention that crypto receives. Think of things like the number of comments and upvotes on crypto-related subreddits, the number of views and likes on crypto-related videos here on YouTube. When these metrics start to fall, when people just get less interested in hearing about and talking about crypto, that will probably be the best indicator of crypto winter. It's also probably worth noting that sentiment was poor yesterday for crypto, so if crypto is a weekend bellwether, we might see poor sentiment in small Nasdaq stocks as well, and we're already seeing poor sentiment in European markets over here. Now, for a bit of news from a country we don't usually tackle, there are some problems in New Zealand. Of course, New Zealand took a very strict set of measures against COVID over the last 2 years, and for the first year or so, the company got a lot of praise because everything seemed to be going quite well. They, for the most part, managed to stop COVID from taking hold, and they prevented lots of deaths. Their whole strategy, however, depended on vaccines coming out and protecting the population in its entirety and stopping transmission between people as well. Of course, that part just didn't work out, and New Zealand has found itself in some sort of limbo ever since. Vaccines do not stop transmission. It wasn't clear if they were going to or not before we saw billions of doses given out, but now that much is clear. This basically means that zero COVID policies are impossible. They are literally never going to work, and the pragmatic thing to do now is to learn to live with COVID as an endemic virus like we live with many other endemic illnesses. New Zealand hasn't got to that point though. They haven't really accepted this, and as a result they aren't able to move on, and as the rest of the world has grown up a bit, New Zealand is starting to get a lot of negative attention regarding all of this. New restrictions in New Zealand are coming into force. New mask rules and limits on gatherings are now in place right now. Vaccine passes are in use as well. Jacinda Ardern has now actually cancelled her wedding as these new restrictions are now present. The country has basically been closed down since March of 2020 from foreigners, which has absolutely decimated their tourism industry, and there is no sight of when this might end. Of course, this all costs the country money and wealth, and their economy is getting hit. Last quarter, their economy contracted by almost 4% in one quarter alone. The New Zealand dollar has lost about 10% of its value over the last year, falling from about 73 US cents to now about 67 US cents, and it is still trending downwards. Now, this is even despite the Reserve Bank of New Zealand actually being pretty hawkish and quite sensible when it comes to fighting inflation. Businesses are being told to prepare for more labour shortages and supply disruptions as these new restrictions take hold, though thankfully the country isn't resorting to full-scale national or regional lockdowns, so more progress on the policy side is being made. Also, the country has been fiscally responsible in the past. Their debt to GDP is far lower than most other Western nations, and while the country isn't exactly rich by Western or Anglospheric standards, the government is at least solvent and should be able to return to a budget surplus once they emerge from all this, so it is by no means all bad news for New Zealand. Now over to China, and we see more turmoil, yet at the same time some investor optimism. Now investor optimism in China is a little bit rare these days, so what has got some people with some cash happy? Well, Evergrande has shown some progress in restructuring some of its debt. The share price actually rose about 14% over the last week or so. Again, it's still down 94% from its all-time highs, so the company is still sitting at an awful level, and in order to erase those drops, it would have to see a 900% increase in its share price. The news as well is basically just the idea that a state-owned debt manager has been appointed to the board. So the idea is that this shows the CCP is willing to help the company out a bit. And this small bump in share price is an indication of the fact that the state might help out with their debt. Now, this is something that is absolutely impossible to predict. No one knows what the CCP will do next, and anyone who claims that they do know is lying to you, or they are the CCP. My idea or thought process surrounding not only Evergrande but most other distressed property developers in China is that the state will essentially save the companies from utter bankruptcy, but only just, and by the end of it, the developers will basically be state-owned companies, and the industry will be dominated by the state as well. This support from the CCP does seem to push Evergrande in that direction, so maybe I'll end up being right, but to be perfectly honest, that's just what I think is most likely. The CCP being the CCP, I won't be at all surprised if they go in a completely different direction to that. Now, the company, Evergrande that is, has another $350 million to pay today, on Monday actually. Who knows if they will pay? We'll find out shortly, but don't expect too much from them here. There are lots of talks about asset sales from other troubled firms as well. Again, the idea being that state-run banks or local governments and the like will buy them, and this will probably just end up being a soft bailout for the industry if it all goes forward. Otherwise, in China or in Hong Kong actually, more bad news. A company that sells fragrances and perfumes, things like that created the fortunes of one of the richest women in China, has just seen its share price collapse 67% in one day. The company is apparently being probed by state authorities for disciplinary actions. What that actually means, no one really knows, but this seems like just another Chinese crackdown on a business and a wealthy person. Again, wealth has been destroyed and lost, the country is poorer, but the CCP is increasing their levels of control. Next time you hear about common prosperity from the CCP, just think about how much wealth has been destroyed over the last year in China and think whether or not that has actually made the poor of the country any richer. Now, an ex-advisor to the People's Bank of China has come out and said that China cutting interest rates is not going to be enough to rescue their economy, and the state needs to do more than that. He's also calling for loads more spending by the government, apparently completely unaware that unnecessary infrastructure projects are the main reason that China is in this problem in the first place. Now, in Hong Kong, again, evidence of more and more people leaving is growing, with private school fees dropping drastically as the schools struggle to find enough pupils to fill their classrooms. This exodus from the city comes after other countries, notably the UK and the US, have made it easier for people to emigrate away as a result of the CCP's erosion of Hong Kong's and its citizens' rights. In short, this is bad news for the city, and not great for China either, but the CCP might not be too upset at people who are opposing them leaving the city anyway, it's just a little bit less drama for them. Now, speaking of the UK and China, the second largest lender in China is doubling down on its London-based businesses and hoping to fuel some expansion over here. The company is China Construction Bank, and it is banking on increasing cooperation between China and the UK, which is contrary to what most people are thinking these days. This is good news for wealth in London. It's going to make some people very wealthy, but definitely bad for the state of the city as a whole. Chinese influence is already proving to be far more present in the country than people had realised, with Chinese spies being found in MPs' staff and universities all over the country being compromised by the CCP as well. Of course, if you go back 10 years or so, the British government was hailing a new age in British-Sino relations, celebrated with a trip by Xi to the UK. It is now, however, abundantly clear that that was a huge mistake and that China is not interested in being friends. If we have one big positive from the COVID pandemic, it's that the world has finally woken and realised what the CCP really is. Elsewhere in the UK now, the Prime Minister is under attack again, this time after apparently failing to help a staff member who claims she was fired for being a Muslim. To be honest, this seems again to be a targeted attack to get him to resign, just like all this nonsense with parties over the past few weeks. Some people seem not to understand my point of view on this. I don't like Boris. I think he's performed awfully, and I sincerely hope he leaves office and we can see someone with more integrity enter the position. But he has a 76-seat majority, so this news means nothing to him, and the chances are these scandals are going to keep popping up, and within a few weeks they'll all be forgotten as well. Now that isn't just wishful thinking, I assure you. It's just what is likely to happen based on what has already happened over the last 2 years. Unfortunately, for the time being, it looks like Boris is here to stay. Now over in Australia, and bond yields are rising pretty drastically as inflation in the country is rising as well. The consensus at the moment is that the central bank will end quantitative easing and it's going to turn hawkish to try and fight inflation. Interest rates are also expected to rise, and if the CPI data from the fourth quarter comes through and it's bad, then the deal will pretty much be sealed and Australia will be turning hawkish. This, of course, has some investors worrying for the exact same reason investors are worrying in the US as well, but at least the markets in Australia aren't quite as speculative, so it's unlikely they'll fall as much as they will in America. Either way though, Australia is a market to watch this week. Now, European markets seem to be worrying again, partly on inflation and quantitative tightening news, but also on how the Ukraine situation is going to hit Europe. There are lots of talks of sanctions going around, and they won't just hurt Russia, they will hurt European countries as well, especially in regards to energy prices. So markets are just a little bit skittish over here, and it's worth keeping an eye on them for the rest of this week too. Now, in random news, Lamborghini have announced that they're not going to be making any vehicles without at least plug-in hybrid powertrains from 2023. Now, this isn't exactly surprising. It's part of the VW group, which has gone pretty hard in the direction of electrifying their fleet recently. That doesn't mean that it isn't a shame though. As someone who likes cars, Lamborghini makes some awesome engines. Their V10s and V12s are pretty much the only engines like them on the market today that are still naturally aspirated, and plug-in hybrids are just the worst of both worlds and inspire no passion in anyone. Again, this isn't a surprise, it's been a long time coming, this is just the way the world is going, but it would be nice if enthusiast cars, niche car makers and the like would be allowed to continue to make cars as they want and as consumers want into the future. I mean, one single cruise ship pollutes more than every single Lamborghini in the world, and yet cruise ships are not being targeted at all the way they are, and yet cars like Lamborghinis with their little big engines are being targeted. Now that is it for today. The Netflix video is coming out later today, but it's quite chilled, it's not at all scripted, and just basically me summarizing my thoughts on the company and why it saw such a sharp crash and if it's all justified. If all goes well, if you guys like that video, I'll put together another one on Coinbase next. If you want to vote on these videos, then join the Patreon and you can do that. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up. You don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.